Hi, everybody. Welcome and thank you for joining us for a self-directed IRA Saturday. My name is Zach Wilson. I'm one of the IRA specialists here at Quest Trust Company. So before we get started, I got to give you the disclaimer. Everything that you're about to see here is for your educational purposes only. It's important to understand the role that Quest will play when it comes to your retirement investments within your IRA. We're here to offer as many resources and as much education as we can, as well as facilitate any transaction that you like within your IRA. But with that being said, Quest does not offer any sort of tax, legal, or investment advice, nor do we endorse any specific investment. So, for those of you who don't know us, we are Quest Trust Company. We're the largest self-directed IRA custodian in the state of Texas. We have roughly 20,000 active investor clients all across the country. As it stands, we have over 2.7 billion in assets under administration, and we're about to hit that 2.8. We're hoping it keeps climbing from there. Also, we have over 100 employees, 34 of which are certified IRA service professionals. What does that mean? So first, that means whenever you give us a call, you're not going to get an answering machine. You're going to get someone who's going to answer the phone and be able to answer most questions that you have. And if you want to take a deeper dive, we have 34 certified IRA service professionals there to take that dive with you. And as it stands right now, we have over $400 million in undirected cash sitting in our clients' accounts. That cash represents opportunity. Right? Whether you're a part of that current Quest pool or you're someone who needs funds to get your deal going, this is where you're going to find that opportunity. But before you pursue any sort of investment, the first step is to always educate yourself. All right, so take advantage of the free education that we offer. Check out our YouTube channel. Check out the education center that we have. We have hundreds of videos going over just about every type of aspect, every type of investment within and outside of an IRA when it comes to alternative assets. All right, we have due diligence videos. We have all kinds of videos that can help you in your pursuit for your investments. But the deal's not going to make itself happen, right? So once you feel educated and you found the type of investment that you're looking to pursue, take advantage of the networking opportunities that we have. Come to the classes that we have on Saturdays and Tuesdays that we're starting back up. All right, check out these virtual happy hour that we have on the fourth Wednesday of every month. And make sure to come to our most popular networking event, which is the SDIRA Socials. That's going to be on the first, second, and third Tuesday of every month in Houston, Austin, and Dallas, respectively. So how this works, it starts at 6:30, and we're planning to start it a little bit earlier moving forward. What we'll do is it's networking for about an hour, right, up until 7. Then from there, there's going to be a presenter that's going to come out, speak for about 45 minutes over a given topic. Topic ranges is going to be different every single time. And then after that, we allow for more networking and deal pitching, right? So if you're wanting to raise capital, or if you're wanting to get your deal out there and you want to get in front of people within the Quest network, check out one of these socials. That's going to be the best opportunity to do so. And if you're a Quest client or you're looking to become a Quest client, make sure to take advantage of our rewards for deposit. It's still going on through the end of this month, right? So how it works is if you're moving over a qualifying amount, right? So obviously you're seeing the ranges right there. What we're going to do is actually we're going to credit your account back depending upon how much you moved in. That can go towards future fees if you like. So that way, maybe you move some in and you get your investment, right? That acquisition now is going to be free for you. So make sure you're taking advantage of that rewards for deposits. Also, come check us out in Dallas for our Elite Multifamily Summit. Right, so we're going to be going over all types of aspects when it comes to this multifamily investing. Right, so come check us out. It's going to be in the Omni Los Colinas Hotel in Dallas, Texas, on August 12th, 2023. So it'll be this year. But next year we are bringing back the Quest Expo. All right, we took a year off because we wanted to make sure we gave ourselves enough time to be able to present the event that we want to. All right, so if you check it out, that building in the background is actually where it's going to be held. It's going to be in Irving, Texas, in June 28th and 29th in 2024. Obviously, there's still a lot of planning going on. We're still getting people coming in. We're still getting sponsorships, speakers, all of that. But this is going to be the biggest expo yet. So make sure you're coming out, checking out that expo. If you have any questions, give us a call. Ask to speak to our marketing team or our IRA specialist team. We'll be happy to help you out. And you can find us here. Reach out to one of us, give us a call, ask to speak to an IRA specialist, whether it's about the events coming up or about some questions within your IRA. We'll be happy to help. So what we're going to be going over today is something that I think is crucial to consider whenever you're making your investments, right? Because we all like to think, oh, I'm going to make an investment. It's going to go well. I'm going to get a return, right? But it's not always that simple. It's not always that straightforward. especially when you get into things like syndications. These investments are, there's going to be some losses there, not planned losses, but you need to know how to handle those and how to take advantage of those, right? So you can be in your best financial situation. So to go over that and what that looks like with both inside and outside of your IRA, I want to bring on Brandon Hall. Brandon, you there?
I'm here. Good morning or good
Good morning.
afternoon, depending on where you're at.
Yeah, right. All right, Brandon. So I'm going to let you take the floor from here. And then, guys, make sure you're taking advantage of the chat. Ask the questions. We're going to answer any IRA questions that you have within there and questions for Brandon. We're going to save it till the end to go over some Q&A. So, Brandon, without further ado, the floor is yours.
Thanks, Zach.
No
Hi,
problem.
everyone. Thank you for joining today. My name is Brandon Hall. I am a CPA, and I'm the CEO of Hall CPA. It's a firm I founded back in 2016. We currently service around 800 clients across the United States. Every one of our clients is invested in real estate in some way, shape, or form. We work with really small clients who are just buying their first property, and we work with really large clients who have 9-figure portfolios and also billion-dollar portfolios. We provide them full outsourced accounting services, CFO services, that type of thing. So it's really cool the way that our firm has grown. We can work with everybody at every part of their journey in real estate, which is really neat. My team is made up of 42 people in the United States. We have 10 additional people in the Philippines and 10 additional people in India. We provide tax planning, tax preparation, and accounting services to our clients. And like I said, all of our clients are real estate investors. We do work with many syndicates and funds on the GP side, and we work with a ton of limited partners because a lot of our clients who are buying real estate are also investing $50,000, $100,000, $150,000 into various syndicates and funds. So today, what I want to go over is the passive activity loss rules. I'm then going to talk a little bit about the difference between a syndication and a fund, and then we're going to touch on retirement accounts. But I always like to start with the passive activity loss rules because what you may or may not realize is you are subject to these rules. Even if you don't own real estate, everybody in the United States, every single taxpayer is subject to the passive activity loss rules, but we often don't learn about them until we start investing in real estate. And we'll kind of piece together why that is through this presentation. So, why should you care about the passive activity loss rules? Well, first, all activities are either passive or non-passive. So I always like to think about it as like two buckets of income. You've got the passive income bucket and you have the non-passive income bucket. In your passive income bucket are going to be all your rental activities in any trade or business that you don't materially participate in. In your non-passive bucket is going to be your W-2 income, the business income that you might actively participate in, right? Like I run my CPA firm. So my CPA firm income is non-passive because I'm actively involved on an ongoing basis. And there's some other things in the non-passive bucket, which we might get to in a little bit. But the problem is that anything that gets pushed into that passive bucket, it comes with certain rules. And those rules limit your ability to claim losses, right? And we'll be going over all of this, so don't worry, just macro view at this point. But because these rules limit our ability to take losses, and because of time value of money, we have to understand how these rules work because at the end of the day, we don't want our losses to be limited. So we want to start looking for exceptions to the rules. How do we get around the rules? There are 3 exceptions to the rules, which we will go over. There's also a special loophole if you're investing in like Airbnb and VRBO type properties, which I don't think that we're going to hit today. But a lot of tax advisors struggle with this. A lot of CPAs struggle with this. Typically, when we see firms struggling with it or CPA struggling with this, it's because they don't work with a ton of real estate clients on an ongoing basis. So like if you are investing in real estate and you're working with the same CPA that you've been working with even before you're investing in real estate, you got to wonder how many clients they have that are investing in real estate because these rules apply, these passive activity loss rules apply, and they're pretty complex, and they can be very nuanced. So if your CPA is involved in real estate every single day, they may not understand all the intricacies, and that's where we start to see some mistakes. So let's go over the passive activity loss rules. Back in 1986, Section 469 was added to the Internal Revenue Code, and the whole purpose was to prevent abuse of tax shelter. So they basically tagged all rentals as a passive activity. They put all these rentals into this passive bucket, and they basically said if your rentals create a tax loss, or if any passive activity creates a loss, it just gets suspended and carried forward. You can't use the loss to offset your W-2 income because your W-2 income is going to be in the non-passive bucket. That's what these rules back in 1986 did. So before 1986, if you were a landlord, or if you were like a high income W-2 earner, you could go buy rental properties and you could use depreciation to create tax losses to then offset your W-2 income, right? So really great time to be a landlord because I could just roll all my money into real estate, create these large tax losses, offset my W-2 income, not have to worry about tax. So in 1986, they stopped that treatment. They basically said, you can keep buying rentals if you want, but now if those rentals produce a tax loss, you cannot use that tax loss to offset your W-2 income. So it created two separate buckets of income. There is a caveat, of course, there are exceptions to these rules, which we will go over, but for the most part, that's what the purpose was. So the purpose was to kind of stop the wealthy taxpayers from using rental real estate as a tax shelter. So Section 469, the passive activity rules say that there's two types of passive activities. Number one, all rental real estate activities are passive unless you qualify as a real estate professional, and that is Section 469C7 here. And then number two, any trade or business in which the taxpayer does not materially participate. So if you are not actively involved in a trade or business, if you do not materially participate, then that business is passive. So for example, if I invested $100,000 into a syndication, right? I'm not going to be materially participating in that syndication, so that's passive. If I invested $100,000 into my local hair salon, and they use that money for expansion or whatever, for whatever purpose, but I'm not actively participating in the hair salon. I don't have voting rights. I'm not involved in management. I'm literally just a capital partner and I get a small slice of the equity. That's also a passive activity. So that passive income flows into my passive bucket, and my rental losses could offset that income, right? Even though the rental, everybody gets confused about, oh, it's rentals though. Rentals can't offset other type of income. They can. They absolutely can. The question though is, what bucket are they falling into? The passive bucket or the non-passive bucket? So they can always offset anything that's going into the passive bucket. What you can't do though is create rental losses and then use those losses to offset the non-passive income that you have, because we're in two separate buckets, unless you qualify for one of the exceptions to the rules. So, why did Congress do this? Why did they implement these rules back in 1986? Like, what, we're preventing a tax shelter, but why, who cares, right? Well, the big thing is this first one. Rentals generate tax losses even when they're profitable. So I could have gross rents of $10,000. I could have expenses of $8,000, right? And my net operating income is $2,000. So $2,000 hit my pocket. But what we don't see is an additional, say, $3,000 of depreciation expense. So even though I have net operating income of $2,000 and $2,000 of cold hard cash hit my pocket, we also have $3,000 of depreciation expense. So I get to tell the IRS that I actually lost money. I lost $1,000, right? 2K of net operating income minus $3,000 depreciation expense. So the point is that Congress realized wealthy people were using rental real estate to not only create additional cash flow, additional income streams, and not pay tax on that, but they were also using that extra $1,000 tax loss to offset their W-2 income at the time. So they felt like they had to stop this. So rentals generate tax losses even when they're profitable. And then the material participation standards are too low. I'm not going to go into that, but I will talk about the new material participation standards that we have, or new as of 1986. So old, I guess. Okay. What about investment income? This kind of trips people up sometimes. Investment income is like gross income from interest, dividends, and annuities. These are going to be considered not from a passive activity. Now, what does that mean? That means that it's not technically a passive, it's not a passive activity. It's not also technically a non-passive activity, but it is not from a passive activity. So that's going to flow into my non-passive bucket. All right. Which I know it sounds kind of weird. So my interest income, you might feel like you don't have to do anything to collect that income, right? It's just coming to you. That's pretty passive. Dividends, pretty passive. Capital gain, gain on sale of capital assets like stock, that's pretty passive, right? But for the purposes of Section 469, they basically took all that income and they said, yeah, we're not going to allow you to use rental losses to offset that income. That's their whole thinking, right? So they basically said, yeah, we get that that's passive, but we're actually going to push that into the non-passive bucket, just like your W-2 income and any business income where you do actively participate. So it's kind of weird, but again, the whole purpose is to kind of segment off rental real estate so that you can't use rental real estate as a tax sheltering technique. That was the whole purpose. All right. All right. So if you can materially participate, if you can qualify as a real estate professional and materially participate, then your rentals are not passive. Okay. Or if you materially participate in a business, then the business is not passive. So again, we have two buckets of income, and Section 469 says there's two types of passive activities that go into that passive bucket, right? All rentals, unless you qualify as a real estate professional, and any trade or business that you do not materially participate in. So it's really important to understand material participation. There are 7 tests of material participation. However, the 3 that we see most often are right here. Your participation constitutes substantially all the participation, meaning that you do all the work, nobody else touches it. In theory, you could achieve this with maybe 50 hours, right? 60 hours, 70 hours, 80 hours. Doesn't have to be a whole lot if you're the only person doing the work. It does have to be regular, continuous, and substantial. So that's where the question mark of like how many hours do you actually need to contribute to this activity would rest. But that is test number 1. Test number 2, your participation is 100 hours and more than anyone else. So like an example I always like to use here is if you're investing in short-term rentals, you hire a cleaning crew, right? But your cleaning crew works 107 hours. Well, if you want to materially participate, you have to work 100 hours and more than the cleaning crew. So you need to work 108 hours. You need to outwork everybody else. So if somebody else is helping you with the property, now you're looking at or business, I should say. Now you're looking at point number 2 there, 100 hours and outworking everybody else. Or point number 3, or test number 3, you can participate in the activity for more than 500 hours during the year, and you will be materially participating. So the reason that we're talking about material participation here is because passive activities don't have material participation, right? So when I look at my passive activities, those are all the activities that I'm not materially participating. But I want to understand what the material participation thresholds look like, because if I can move a rental property out of the passive bucket and into the non-passive bucket, where my W-2 income is and my business income is and my interest in capital gains and dividend income is, if I can make that happen, then I can cost segregate my rental property and I can accelerate depreciation on my rental property. And that will create a tax loss from my rental property. And that tax loss might be large, but I could then use that tax loss to offset my W-2 income, my business income, interest, gains, whatever other type of income in that non-passive bucket. So the first major question that we have to ask is, can we move our rental out of the passive bucket and into the non-passive bucket by participating, right? Now with rentals, I have to first qualify as a real estate professional, and then I have to materially participate. But I wanted to touch on material participation because material participation not only applies to the rentals, but it applies to any business that might be in that passive bucket too. Like that hair salon example that I was talking about. You know, if I invest $100,000, but I don't meet one of these 3 tests, then I'm not going to be materially participating, right? So if I'm not doing a whole bunch of work, you can see here how it would be a passive activity for me. And that might be advantageous or disadvantageous. It just depends on your facts and circumstances. All right, so let's talk about how do you get around the passive activity loss rules. And before we talk about how, again, I want to reemphasize why this should be important to you. The passive activity loss rules, any investment that you make in real estate is going to be automatically passive. That's the default classification. So that means that when I go invest $100,000 into a syndication and I get this $80,000 K1 loss, that K1 loss is going right into my passive bucket. I cannot use it to offset my W2 income or my business income. If I invest in an ATM syndication, right? I know that those are like, big time now. So I go and invest in an ATM syndication. Same thing. If I'm not materially participating, it goes into the passive bucket. It doesn't matter that my K1 has box 1 ordinary income filled out. It doesn't matter how the K1's filled out. What matters is how much time did I spend in the activity. And that's a really important point to understand, by the way, because what we have found is a lot of accountants who don't understand the passive activity loss rules will look at a K1, and if there's any amount in box 1 that's ordinary income on the K1, they will assume it's non-passive. If there's any amount in box 2 that's rental real estate, they'll assume it's passive. And neither one of those assumptions are true. They could be true, but they could also be false, because box 1, ordinary income, I could be getting that from an ATM machine. I could be getting that from my hair salon investment that I made, but I'm not materially participating in either one of these things. So that's a passive activity. That should go into my passive bucket, and it'll net out against all my other passive activities that I have. And I'm going to show you how it all nets out here in a few minutes. All right. But in box 2, rental real estate, it doesn't always have to be passive, right? I just kind of told you, if you qualify as a real estate professional and materially participate, then box 2 is non-passive. So it's really important to understand that just because it shows up a certain way in your K1 does not matter for the passive activity loss rules. What matters for the passive activity loss rules is, did you materially participate? Did you qualify for one of these exceptions to the rules? So that's the big idea. Because again, if we can get these activities out of the passive bucket and put them into the non-passive bucket, now we can use them to offset our W2 income, our business income, 401k rollover to Roth income, that type of stuff. Like, all that can be offset with losses from passive activities that we're able to move into the non-passive bucket. So there's 3 ways to get around these passive activity loss rules. The first way is to simply sell your passive activity. If you sell a passive activity at a gain, passive losses from that activity and other activities can be used to offset the gain on sale. Now, this is something that, interestingly, we often hear feedback that CPAs or tax pros are not allowing their clients to like net it all out, which doesn't make any sense. I'm going to show this to you. But I want you to walk away from this presentation understanding that losses from one activity can absolutely offset income from another activity, including the gain on sale from that activity. Okay. So losses from a passive activity can offset income from a passive activity and can offset gain on sale from a passive activity. Doesn't matter if it's a limited partnership loss that's offsetting my hair salon income. Doesn't matter if it's a limited partnership loss offsetting my rental property income. Doesn't matter if it's a rental property loss offsetting my limited partnership gain on sale. They're all passive activities, so they all net out against each other, which is pretty powerful. And it could be rich dad, poor dad on steroids if you play your cards right. So number 2, if you earn less than $150,000, actively participate in the activity, and own 10% of the activity, you qualify for something called the passive activity loss allowance. Now, you get the full allowance if you earn less than $100,000, but that allowance starts to phase out. And this is the phase out, but it starts to phase out, and it's fully phased out once you hit $150,000. So if you're trying to figure out, like, how do I drop my income below 150K to use my loss allowance, you really got to drop it to like 125 or so $1,000 to make any sort of impact. Because if you drop your income to 149,000 bucks, you're only going to qualify for a $500 loss allowance, not the full $25,000. So important to understand that it is a phase out, but this is really nice because I don't have to do anything crazy in order to use my passive losses. I just have to buy a rental property. I have to manage it. Or I can have a property manager manage it, because active participation just means making management decisions, right? I don't have to be the one actually swinging the hammer, so I can still be relatively passive in this activity. At least as long as I own 10% of it, I can use the rental losses to offset my W-2 income as long as I earn less than 100K or less than 150K. But now I'm going to have a phased out limitation of this $25,000 allowance that I could otherwise claim. The third way to get around the passive activity loss rules is to qualify as a real estate professional. Now, if your losses are passive, if your losses are passive and you have like losses in excess of passive income, what then, right? So we're looking at this passive bucket. My rental losses are $20,000. My other passive income is $10,000. So my net passive losses are $10,000, negative $10,000. What happens then? Well, they get suspended and they get carried forward indefinitely. So it's not that bad of a deal because now I have a little cushion of $10,000 that can offset future passive income, can also offset future gain on sale of passive activities. It's not that big of a deal, but it is suboptimal from a tax optimization perspective, right? We want to utilize losses as much and as often as we can because of the time value of money. If you look at the past couple of years, we've had pretty crazy high inflation rates. Well, by you not accelerated depreciation, not getting that tax benefit back into your pocket, you're effectively leaving the tax benefit in the rental property, and it's being eroded every single year with inflation. Now, if that doesn't make much sense to you, let's put it another way. You would probably agree that if you had $1 million, you should not leave it in a savings account right now that earns 1% interest, right? Especially when inflation is 3, 4, 5, 6%, and over the past few years, 8, 9%. Because if you're only earning 1% on your $1 million, but the cost of goods around you are going up by 8% a year, your $1 million, the value of your $1 million is eroding because you can't keep up with the cost of goods that are increasing. The same dollar that you could have used to buy a half gallon of milk 3 years ago, you can't afford it today. Now that half gallon of milk is $1.20. You're missing the extra 20 cents. So you wouldn't leave $1 million just sitting in a bank account earning very little interest. But then again, people are so fine just not using their depreciation the way that they should. They don't want to accelerate it because they're scared of depreciation recapture at the end. They want to smooth it all out because they're afraid they're going to be in a higher tax bracket later. All reasonable thoughts, but at the end of the day, inflation's your number one enemy, and it's chomping at your heels. And you've got to extract that tax benefit out of that rental property so that you can redeploy it in other investments, just like you would take that $1 million out of that savings account and redeploy that into other investments that earn a lot more than 1%. So I want to talk about how the netting effect kind of works here. When you, and this is form 8582, if you are investing in real estate outside of a retirement account, then everybody should have this in their tax returns, most likely. So go pull up your tax returns. You can just control F8582. It'll take you right to it or close to it. You can just keep hitting enter until you get to it. This is probably the most important tax form in your entire tax return. I would say it's more important than your 1040, than your Schedule E, Schedule C. The reason for that is twofold. One, it shows all the netting effects of all of your passive activities. But two, it allows you to track your suspended passive losses year after year after year, which is really important. We have seen people make decisions without consulting their form 8582. For example, we've seen people go through a 1031 exchange process when they had negative 500K of losses that they were carrying forward, right? And it was showing up right here. If you have 500K of suspended losses that are carrying forward year after year, you probably don't have to do a 1031 exchange. You can just sell the property, and then your suspended passive losses will be used to offset the gain on sale. Really simple, right? We have also seen times where people switch CPAs, and the new CPA forgets to record the carryover losses, the suspended losses that are on Form 8582, and they just kind of disappear. So it's really important for you to track this information. I recommend that you have a spreadsheet that you update every single year so that it just kind of gives you some accountability and forces you to take a look at these numbers every single year. All right, so at the top here, Section 1, we've got rental real estate. So this is going to be like any of my own investing in rental real estate. So if I go buy long-term rentals or midterm rentals, whatever, this is where the aggregate performance is going to be recorded. So in the current year, if I had net income after depreciation from my rentals, I'm going to put it here. If I had net losses, and this is looked at on activity by activity basis, so I could have 3 rentals with income that would go here, 3 rentals with losses that would go here. But my current losses are going to go here. And then my suspended losses, my losses from prior years that I haven't used, that's going to go on 1C. And then we're going to net it all out on 1D. So what this box shows you is that all rentals can offset each other. So rental income from one rental can be offset by rental losses from another rental. Rental gain on sale from a rental can be offset by rental losses. Gain on sale from a rental is going to go right here in 1A. You report gain on sale from a rental on form 4797, and it tells you also report this on form 8582 in box 1A. So the gain on sale of the rental property gets reported on 1A and can be offset by losses from other rental properties. Kind of cool. But they all net out against each other on 1D here. And then all other passive activities, this is going to be where I invest in a syndication as an LP. Again, outside of my retirement account. So I know that some of you might be listening and investing through a retirement account. This is not going to apply to you because this is part of your 1040, and your SDIRA, solo 401ks don't file 1040s. So this is going to be where all other passive activities are reported. My LP investments that I make, that hair salon investment that I keep referring to, if I get a K1 from that, that's where this is going to go. So any income is going to be reported here. Losses will be reported here. And then suspended losses from prior years that I was unable to use, will be reported right here. That will be reported on box 2D. And then box 3 nets box 2D and 1D. So if you ever get a tax pro that says you cannot use your syndication loss to offset the gain on sale from your rental property, or you cannot use your syndication loss to offset this passive surgical centered net income, you cannot use your LP loss to offset rental property income, you tell them phooey, you say go fill out a draft form 8582 for me and tell me what you've come up with, because I promise you they will be surprised when they see that netting effect happening on box 3. All right, let's talk about what a syndication is. So I keep referring to syndicate, funds, all that stuff. So a syndicate is a group of investors that pool capital to buy a larger building collectively. All right. So, it's kind of hard for like if I was driving down the street and I saw a $10 million apartment building for sale and I wanted to buy that apartment building, it would be kind of difficult for me to buy that apartment building alone. So I might call up my friends and family. I might reach out to colleagues, and I might try to get people to invest $100,000 each. I'll pool their money, and collectively we'll go buy the $10 million apartment building. That in essence is a syndication. Syndicates are typically structured with an LLC. There's typically a holding LLC and a management LLC. GPs means that they're general partners. They assume the risk. LPs are limited partners. Their risk is limited to their investments. And syndications are typically single asset focused. So conversely, a fund is going to be multi-asset focused. So very similar to a syndicate in that we're going to pool a bunch of investor capital and go buy things, but they're typically larger in size in terms of total capital raised. They acquire many assets, and investors can come and go. Now, when you're looking at investing in a syndication or a fund, it's important to review the operating agreement. Every syndication and every fund has an operating agreement with the PPM. The PPM is not the operating agreement, by the way. The PPM is here's why the GP is an awful person and you should never invest with them. It's a risk statement, right? They're trying to reduce their own liability. They're trying to put all the risks out on the table to make you fully aware of them. There will be some things from the operating agreement in the PPM, but it's really important to understand that the PPM is not a substitute for the operating agreement itself. You need to go to the operating agreement to understand everything that can, like how the fund is going to distribute cash during operations. If there are no profits in the event of sale, that's what we want to look at the operating agreement for. It'll give you that waterfall that you're probably looking for. So there's a few things that you need to check out in this operating agreement. The first one is profit and losses. So how do profit and losses get allocated between the LP and the GP? Typically, losses are going to be allocated pro rata, but sometimes they're allocated in funky ways. Sometimes there's a waterfall approach. You also want to look for a preferred return. Is that going to be accruing? If so, how often is it accruing? And based on what capital? Is it the capital that you contributed? Is it your unreturned capital? If you earned additional money and you didn't get that distribution, is that part of the calculation? So really important to understand that profit and loss section. Also important to understand the distribution section as well. So who gets paid what and when, right? Obviously that makes a lot of sense. So I want to know when I'm getting paid. That's going to be in that distribution section. And again, that could contain that waterfall as well. A waterfall is going to be like, first we distribute capital to our preferred return folks. Then we distribute capital to our LPs until they receive a return of like 10%. Then we distribute capital 50-50 between the GP and the LP. That's a waterfall, right? And you could have multiple layers to the waterfall. Waterfall is actually pretty good. You do want the GP to be paid, but you want the GP to be also really motivated, right? So I would be somewhat comfortable with an approach where once the LPs accrue 15%, the GPs get 70% of everything after that, and the LPs get 30% of everything after that. As an LP, you know that your GP is very motivated to get you to a 15% return, which is pretty darn good as an LP. And so, yeah, everything above that, they can have the lion's share of. So a waterfall helps motivate the GP to perform. And it's often a very good thing to have in an operating agreement. And then liquidation, this is very important. Typically, liquidations are going to follow distributions. But what happens when we sell the property and we earned $5 million in gains? Where do those get distributed? Who do they get distributed to, and by what, and to what extent? So there's always a liquidation section in these operating agreements. Now, what do you ask deal sponsors? First, on the finance side, how do you plan to distribute your cash flow? When should I expect to see financial reports? When do you plan on having K1s out? Will you be performing a cost segregation study? What type of debt are you using? This is an important one these days. I think over the past couple years, we've seen a lot of new syndicates spin up on floating rate short-term debt. And right now they are not doing too hot. So really important to understand what type of debt people are using. You want to go for the 5 to 7 year debt. You want to see at least a rate cap that long. Typically speaking, it just reduces risk in the event of what we saw over the past 12 months with rates running up. Do you have a capitalization policy, or do you plan to have one? On the team side, what CPA firm are you working with? What law firm are you working with? Who's your property manager? Who's your bookkeeper, controller, CFO? Like, if they don't have a CPA firm, a reputable CPA firm, a reputable law firm, if they don't have a bookkeeper, controller, CFO, I don't know that I would invest with people that are doing this, because they're not taking your money seriously. You would invest in people that have a good back office built out. Even if it's an outsourced back office, like our firm, for example, we do a lot of outsourced controller and CFO work for syndicates and funds. I don't know that I would invest seeing behind the curtains on a lot of these syndicates and funds. I don't know that I would invest in them unless they had a controller and CFO in some capacity helping them out. So just be really careful. Inquire about the team, make sure that you understand how they're going to be running their operations. And continuity, what happens if you die? What will you do to communicate issues such as performance or below expectations or delays in distributions, as we're seeing a lot now in the market? All right, so let's talk about investing with retirement accounts. So two types of retirement accounts. There's solo 401ks, SDIRAs. I mean, there's a lot of types of retirement accounts, but there's two types that we're going to cover today. So solo 401k, you can invest in syndications and in funds with a solo 401k or with a self-directed IRA. Solo 401k, you have to have self-employment income. You can make a $22,500 employee contribution plus an employer contribution. And then the solo 401k avoids UDFI, unrelated debt finance income. Don't worry, we're going to go over that in a second. On the SDIRA side, all earned income qualifies for contributions. Your contribution can be up to 25% going into a SEP IRA, and then SDIRAs are subject to UDFI. So if you like what happens is when people are investing through a retirement account into real estate syndications and funds, they get the K1 back and then they go, do I have to pay taxes on this income? Is this income subject to UBIT? If you invested through a solo 401k, the answer is going to be no. As long as you're investing in like rental real estate syndicates, the answer is going to be no, because solo 401ks are not subject to UDFI. In a lot of these syndications, UDFI creates the UBIT that you have to pay tax on. But a solo 401k is not subject to UDFI. So solo 401ks typically don't have to worry about paying taxes when they're investing in these syndicates and these funds. So quick pro tip for you there. But we're going to keep going into this so that you fully understand what I'm talking about. All right, so we've got UBTI, UBIT, UDFI. What does all this mean? So let's start with UBTI. It's unrelated business taxable income. So this is the income that is generated from trades or business activities. It applies to all retirement plans. It's meant to level the playing field when tax-exempt entities compete with non-tax exempt entities, right? So it would be kind of unfair for a CPA firm to spin up and be my competitor if they were running out of a retirement account, right? They would have a lot more capital that could continue to reinvest in the business because they're not paying taxes on it. Well, that's why UBIT exists. So both solo 401ks and self-directed IRAs are subject to UBIT. Unrelated debt finance income means it's income derived from leveraged investments. And then unrelated business income tax is the tax paid on the UBTI. All right, so only SDIRAs are subject to UDFI, but both solo 401ks and self-directed IRAs are subject to UBIT. Now, you're only going to have UBIT in a real estate investment if it's like a real estate development or real estate flipping. It's some sort of active trade or business, right? Because UBIT is a tax on unrelated business taxable income. And that is income generated from trades or business activities. These are basically think about it as like non-passive, right? But our rental real estate is not a trade or business activity that is going to be subject to unrelated business taxable income or UBIT. But rental activities will be subject to UBIT when there's UDFI. So if we buy rental real estate with leverage, that's where UDFI kicks in, and therefore UBIT kicks in. So activities that are exempt from UBIT: rental income, dividends, interest, capital gains, royalties. And then, like I said, down here are the things that will generate UBIT: developments and builds, flips, services, venture capital, those types of things. All right, so UDFI, anytime leverage is used to acquire real estate, the income is UDFI. We have to determine what ratio we have to apply, and then that helps us determine the actual tax that we have to pay. So, for example, we buy a $200,000 rental with our self-directed IRA. There's a $160,000 mortgage. The net rental income is $10,000. It's 80% leveraged. So $8,000 of the $10,000 is UDFI. We get a $1,000 exemption. So that means $7,000 is net taxable income reported on Form 990T. $7,000 is unrelated business taxable income, and that's going to be subject to UBIT. That's going to be what we calculate our UBIT on. So really important to understand there. So another example, you invest $100,000 in a syndicate, and that syndicate is 70% leveraged. The investment nets 10% in rental income per year. So the annual net income is $10,000. UDFI is $7,000. That's 70% of net income, less your $1,000 exemption. So UBTI is $6K. UBIT's going to be $1,034. That's at the trust tax rates. So you have to basically take this and then go look up the trust tax rates, and that's kind of how you calculate it. This is very rough, by the way. It's not the exact calculation, but it gives you an idea of how this kind of works. So if you invest, a couple of things. First, if you invest in syndications, invest through a solo 401k, and you won't have this issue. You won't have anything to worry about. But if you are investing through a self-directed IRA, the UBIT is really not that large compared to what you're earning. And you can also, even if the self-directed IRA receives negative income, you can go ahead and file tax returns for that negative income to like kind of lock it in. That way, whenever the syndication liquidates at some future point, has all this gain and everything, you can use that loss that you were never that you kind of like reported. You can use that loss at that time to offset all that gain. So there's different ways to really like knock this down. But UBIT, UBIT is kind of I mean, don't get me wrong, it's tax, it's money, money's important to conserve. I very much believe that, but it's also not something to stress about. I've already kind of talked about this. Solo 401ks avoid UDFI, and that is it. So this is my contact information. Here's my email, brandon.hall@hallcpallc.com. Website is therealestatecpa.com. And if you want to join our free investor group, you can check us out at facebook.com/groups/tax-smart-investors. And I will, Zach,
Awesome.
hi. How
Awesome. Thank you, Brandon. Thank you. All right, so we do have some questions in the chat. So I'm going to bring those up. We'll go through those now.
Sounds good.
All right, let's see here.
Should I stop sharing my screen?
Here, I'll go ahead. No, I'll go ahead and take it down.
Okay, cool.
There we go. All right, so first one is coming here, and obviously, we can't get into her specific situation, but I think the overall question: can I claim losses from previous years in my self-directed IRA since I did not file paperwork under my self-directed IRA before?
Ooh. I believe that there is a way to fix that. I don't know what that is off the top of my head, but I would look into. First, I would call up whoever your custodian is and kind of see if they know if there's a way to retroactively claim those losses. But then I would challenge my CPA to do a little bit of research and figure out what the process might look like. Yeah.
Awesome. Thank you. So next question is going to be asking if is there a difference between non-passive versus active income /loss?
Good question. So technically, I know that I use the term active. A lot of people use active to simplify, like saying non-passive and passive. Technically, there's only passive and non-passive. There's no such thing as active in Section 469. So when you see people say my active income, I think in most cases what they're really trying to say is my non-passive income. But if you use the word I know it's like it's a thing, but if you use the word non-passive, especially when you're talking in the tax context, it'll go a lot further than saying active income. So is there a difference? I don't think so. Maybe, but the technical term is non-passive.
Good deal. I didn't know that. I had no idea. All right, the next question. This is asking, so it said, what about capital gains dividends, dividend income from the stock market? I think this is when you were talking about being able to claim that passive losses against these.
Yeah, and I think I answered that with one of my slides, so I don't know when that question came in, but that is all considered not from a passive activity, so that would go into that non-passive bucket. You would not be able to use rental losses to offset it.
Good deal. Let's see here. So another question asking, what's the difference between the 100 hours per year versus the 500-hour requirement?
Just more time. That's it. You got to spend more time. So if you had like the 500 hours could be beneficial from a one thing I didn't mention is material participation is viewed on a property by property or an activity by activity basis. So if I have 10 rentals, I've got to spend 100 hours and more than anyone else in each of those 10 rentals separately. So that's 1,000 hours, right? Or if you look at the 500-hour test, I got to spend 500 hours in each one of those rentals separately. That's 5,000 hours. But there is a grouping election where you are able to group all of your rental activities together as one for the purposes of these material participation tests. So I could group all 10 rentals together and then spend 500 hours on the group. So the rules, 500 hours at first seems like a lot of extra work, But if you have a large portfolio, it actually really reduces the amount of work you have to put in to manage your entire portfolio, because now it's just spending 500 hours on the entire portfolio rather than activity by activity.
Got it. Got it. And so when we're talking about material participation, if I were to meet that 500-hour requirement, right? Even if there is someone who worked more than me, am I still considered to have materially participated?
Yes. Yeah.
Got
Once
it.
you hit 500 hours, you're good.
It doesn't matter if
Yep.
anyone's worked more. Got it. All right. Next question. So a passive investor who has an LLC, apartment syndication, profit losses are passive. However, business expenses that I incur to run the LLC, is that active or passive losses?
That's also passive. Yep. Great question. So if I set up an LLC or a holding company to then invest in all these passive activities, you have to basically take your business expenses and allocate them between all those activities, and it's all going to be passive at the end of the day.
Yeah,
Yeah.
awesome. All right, so next one. So does UDFI for syndications within a self-directed IRA apply for seller financed projects?
So UDFI applies whenever there's debt. So if I acquired a property with debt, whether it's traditional mortgage, hard money, or seller financing, then UDFI would apply. Yep.
Got it. Next question asking, if you paid UBIT in a self-directed IRA, does it get taxed twice or again when the money is distributed out of that self-directed IRA?
Yeah. I mean, when you distribute money out of that self-directed IRA, it'll be taxed.
Yeah.
Unless you're, of course, investing in a Roth.
Yeah. Next one asking, should a person file a 990T every year, whether there's a gain or a loss?
Yeah, that's a tough one. I don't know. I think it's. I think you see different trains of thoughts on it. I mean, the reality is a lot of the investments that you invest in with your self-directed IRA will produce so little, either way, positive or negative, that the compliance costs alone might not be worth it. But I mean, technically you should be filing a 990T.
Okay.
As long as you meet the filing requirements of the 990T, you should be filing the 990T.
Got it. Next one from Albert asking, is selling a partial of a note owned in my self-directed IRA subject to being taxed?
I guess it would depend on if you were. I don't know. Maybe. I guess it would depend on how often you do this and if it rises to the level of a trade or business. Because if it does, then you would be generating UBTI, unrelated business taxable income, which would then be subject to UBIT. So if you're selling partials all the time and you're flipping notes, then I could see that argument being made. If it's like a one-time thing, I don't know that would be a. I don't know. I think you'd be okay, but
Yeah.
check with your tax accountant.
Got it. And then next one asking, what qualifies someone as a real estate professional for tax purposes?
Yeah, I didn't talk about it in the presentation just because I didn't want to go down that rabbit hole too far, but I will tell you the tests. Qualifying as a real estate professional, you have to spend 750 hours in a real property trade or business. You also have to spend more time in those real property trades or businesses than you do anywhere else. So the more time than anywhere else kicks out everybody that has a full-time job. And that's like the major sort of problem with the passive activity loss rules when Congress implemented them back in 1986. Because what they realized is, hey, if you're a W-2 employee and you're using rentals to offset that income, we want to stop that. So what we're going to do is we're basically going to say they're all passive. Later on, they added real estate professional status, but they made sure to say with real estate professional status, that you have to spend more time in real estate than at your W-2 job or your business. And if you could spend more time in real estate, fine, we'll allow you moving that rental into the non-passive bucket. But you have to work really hard to get there. So anybody with a W-2 job, the IRS will not buy that you are a real estate professional, and the tax court to date has also not bought it. So just be careful claiming it out if you are working a job.
Got it. So another one from saying, so it's going to be for the 100 to 500 hour rule. If I painted my rental house but did not pay myself anything, would the time spent painting count towards the hours?
Yeah, absolutely. You don't have to pay yourself for the hour to count. You just have to be there working and doing the work. Yep.
Got it. And so Vin's asking, what happens to depreciation in a self-directed IRA? And I'm assuming he means like something like a syndication where you're going to get those negative K1s.
Yeah. Yeah. You just get a tax loss. So at the end of the day, depreciation is just a deduction that ultimately determines what shows up on your K1, right? So I could have $10,000 of income, 8K of depreciation, and then $2,000 of income. That 2K shows up on my K1, and that's what I report on my 990T when I'm going through that exercise. So depreciation itself doesn't go anywhere or do anything aside from just create a deduction for me. Now, if I have a loss, I might want to report that on that 990T. I might want to log basically that I have a loss. Same thing with the states. Just kind of depends on what you got going on there. But it is a good question. We often see people invest in like use their retirement accounts to invest in notes in debt funds because interest income is very hard to shelter from taxes. Whereas if I just buy rental real estate or if I invest in a syndication that's buying rental real estate, I get tax sheltering just through exposure to owning rental real estate because of depreciation. So kind of think about like what vehicle you should invest in and what type of assets you should invest in with those vehicles. But yeah, it just you just have a tax loss and you just decide if you want to report that tax loss or not.
Okay. And so for things like like a multifamily syndication, do I need to file that 990T in order to be able to carry that loss forward to apply towards like when I get hit with that UDFI if it was a debt leveraged investment?
Yeah, we've seen it both ways in the past. I think one depends on the state, but in terms of the federal government, I would recommend just filing and logging it. Yeah.
Got it. All right, next question asking if my losses on stock investments in my self-directed IRA are more than 3,000, can I claim for the access of 3K? Or can I claim for that access of 3K?
If my losses on stock investments in my SDIRA
More
are
than
more than $3,000, can I claim? I'm not sure.
it. Zlako, if you could just expand on a little bit, we'd be happy to address that. We'll move on to the next question. If your spouse is a real estate professional and you filed jointly, do both of you count as real estate professionals?
Yes, you do. Well, let me back up. You both don't count as real estate professionals, but your joint tax return will be a real estate professional status tax return, if that makes sense.
Okay,
So
because it's still one taxable entity essentially.
yeah, and I know to a lot of you that probably sounds like the same thing, but there is a nuance in there, which I'm not going to go into. Just know that one spouse has to qualify as a real estate professional by themselves. When they do qualify, your joint tax return will be a real estate professional status tax return. You'll be able to use rentals to offset your W-2 income if you're the working W-2 person.
Okay. And then so the next one asking, can I write off losses in a 401k or an IRA? I'm assuming towards a personal.
No.
Got it. And the next one's asking, can I have an LLC in a self-directed IRA? Yes, you absolutely can. If you have any questions over that, feel free to give us a call. Next one, if a K1 shows accelerated appreciation when it's in an IRA, should I have it redone?
You mean like I think what they're asking is like if I invested in a syndication with my SDIRA and now the K1's got tax losses, should I like swap my personal name out or something for that? I mean, I would say no. That wouldn't that be a violation of the what's it called? You probably know this better than I do.
No,
It's like
but
it's like a distribution of your IRA or something.
yeah. So I mean, they can distribute it to themselves. I mean, that's
Yeah,
I
you
mean,
get like taxes, penalties,
yeah,
all
because
sorts of fun stuff.
we also need a valuation on it. Yeah, it'll be a whole thing. But so I'll move on to the next one. Say, what's the difference between the long-term capital gains tax at 20% versus 15% or other rates? I think it's just the.
I think it's just where your income ends up. So capital gain tax rates, they scale as well. It's just a different tax rate system, but it still scales up. So if you're in the 20% rate, that just means you're in the highest bracket.
Got it.
For capital gain taxes.
All right. So next question saying, should I have my rental property in an LLC name or in my individual name?
That would be an attorney question. I'm not an attorney. I'm sorry, I can't answer that for you.
The next one saying, let's see, we use cost segregation numbers when it's, I'm not sure if this was referring to a different one. I don't know. We'll come back to this one though. Oh, asking if you can post your contact information.
Oh,
yeah, we'll throw that up there again. All right, but it looks like that is all of the questions. And then there's other people asking if your firm accepts new clients and how do they reach out to you. And
yeah.
so,
hold on, let me get my contact information back up. Oh my gosh, what the world?
Yeah, you know, it's all of a sudden gonna run into.
Yeah, there it is. Yeah, no, we're always accepting new clients. I think what you see across the CPA industry right now is that there's a shortage of CPAs, and a lot of CPAs are saying no to new work. My goal is to just build a platform and hire great CPAs to come in and do the work for our clients, and do great work for our clients. And we've been pretty successful at it. So we are a remote CPA firm. Our 42 employees work everywhere in all across the United States. I'm in Raleigh, North Carolina personally, but we don't meet clients face to face unless you go to conferences that we're also at. We love to meet clients face to face there. But because we're remote, I can also grab talent anywhere in the United States at any time. So we don't really have a problem with scaling and bringing on new clients. That's a really long answer to say, yeah, we're taking on new clients. And if you are interested, you can check us out at www.therealestatecpa.com.
Awesome. Thank you so much, Brandon. All right, guys, if you have any questions for Brandon, reach out to him. You see his information right there. If you have any questions regarding your IRA, feel free to give Quest a call, ask to speak to an IRA specialist. We'll be happy to help you out. Brandon, thank you again so much for coming out. Really appreciate it.
Thanks, Zach. I appreciate having me on.
Awesome. Thank you, guys. Well, y'all have a good weekend.
Bye.